Hello, I'm Dave Gardy from our studios here near Washington, D.C. for OREF TV for this special presentation, the first in a series of webinars being produced by OREF TV. Today's presentation will be moderated by OREF trustees Dr. Joshua Jacobs and Dr. Andrew Pollack. Dr. Jacobs, I'll let you take it from here.
Thanks, Dave. Welcome, everyone. I'm Dr. Joshua Jacobs, Chair of the Department of Orthopedic Surgery at Rush University Medical Center in Chicago. I'm also the treasurer of the OREF Board of Trustees. Co-hosting with me today is Dr. Andrew Pollack, chair of the Department of Orthopedics at the University of Maryland and treasurer-elect of the OREF. Andy, you want to say hello?
I have to come off mute to say hello. Hello, everybody. Good to be here.
Thanks, Andy. We've all been affected personally and professionally by the COVID-19 pandemic. While our primary concern is and has been the health of our patients and our families, the crisis has also had an enormous impact on the economy and, of course, on financial markets. Fortunately, thanks to the loyal support of our donors, OREF has been able to maintain its research funding activities during these very challenging times. As a way of saying thanks for that support, OREF is pleased to share with you insights on the current investment climate from DiMeo Schneider Associates. DiMeo Schneider is a fiduciary investment advisory firm headquartered in Chicago with more than $75 billion in assets under advisement. Before we get to their presentation, I want to remind everyone that OREF does not provide financial planning or advice. The opinions expressed in this presentation are those of DiMeo Schneider. Please consult with your financial planner or tax advisor for guidance on any of the advice presented today. And now, I'd like to introduce William Parker and Michael Emerson from DiMeo Schneider. Bill and Mike, please take it away.
Thank you, Dr. Jacobs. As Dr. Jacobs said, my name is William Parker. I'm one of the directors of consulting at DiMeo Schneider Associates. I've been there for 10 years. Joined with me is my colleague, Mike Emerson. Mike, would you like to say hi?
Right. Yep. Hi, everybody. Thanks for having us. My name is Mike Emerson. I'm a senior consultant with DiMeo. We're looking forward to sharing some insights with you guys today.
What we've put together for you here today is a little thing we call the do's and don'ts in volatile markets. We've certainly seen some extremely volatile markets here in the beginning of 2020. And I'll start here on this page just to give you an idea, just to put some context to everything. So what you see here on this first slide, it's asset class performance, and this is through the end of this first quarter of 2020, calendar quarter. So this is March 31st, 2020 as an ending date. And what you see, for those of you who have followed this at all on TV, is a lot of bars in negative territory. Now, the funny thing here is that if you would have looked at this chart, this very chart, about a quarter ago, ending December of 2019, you would have seen literally the inversion of this. So you'd have seen all of the asset classes in positive territory. So 2019 provided a very strong year globally across all asset classes in terms of returns. And what you have here through the end of March, you have your fixed income components in the darker blue, your global equities, US large, US small, international and emerging markets. And then what we would call sort of your alternative asset classes, REITs or real estate investment trusts, commodities, midstream energy, and hedge funds. And what you see, again, is the inverse there. So with the advent of this COVID-19, you really saw markets take a tumble. And that happened from about the end, but third, fourth week in February, all the way through March. So the ending here in March wasn't a great story. It was volatile the entire time. Again, this is one of those times as we're looking at things, certainly at DiMeo Schneider, we're taking a look at all asset classes. We would say this when markets are all in positive territory. What you see on this page is something that is not indicative of a healthy market. This is clearly something that has taken the markets by storm, and Mike will get a little bit into that in a second. I'll just kind of sum up these comments by saying that what we saw with the advent of COVID-19 is all of these markets do a pullback, and they did so in the fastest manner we've ever seen in the history of the stock market. So we'll get to that in a second. In the meantime, Mike will give a little bit more on the context of this in the pages to come.
So 2020 was really been a punch in the mouth for a lot of investors. Coming off a year, to Bill's point, like 2019, where almost every asset class is up double digits to now being down between 10 and 20% in most of your risk asset categories. First things first, what do you need to do? So some of the do's we have, you want to take a deep breath, gather your thoughts. It's very easy to get caught up in everything, and it's a bit cliche, but it's important not to panic and to stick with the plan. Now is the worst possible time to make rash decisions, and as many of you know and have been saving for over 20 years, investors who sell out in the midst of crises also can ruin, not necessarily hurt, but ruin their portfolios and their long-term financial goals and picture. So we saw it in 08 with clients when we saw the big correction, that those who weathered the storm, rebalanced, and continued on with their plan, they've come out, they're now in great shape. But those who sold out and sat in cash missed out on over a decade worth of very strong returns. And so we always remind clients that corrections occur on average every 2 years, bear markets every 5 years. So, it's always going to be a different reason. But as we like to say, the world can only end once. And so history doesn't repeat itself. It does rhyme. This is nothing, we've never seen anything like COVID, but we've seen the situations that the market's found itself in. That being said, many clients would rather not look at the portfolios, and it's easier to just avert your eyes and miss the carnage and know that things are going on in the stock market, but not take stock of what's actually going on into your portfolio. Now is not the time to become an ostrich and bury your head in the sand. And so we've been talking with clients, and that a lot of folks out there, unfortunately, periods of volatility, it's the first time that they've taken a deep dive into what they actually own in their portfolio. Taking a deep dive of what they actually own in their portfolio. But it's important to understand, how are your assets going to respond? How much do you have in cash? How much is in bonds? Do you have US stocks, international stocks? What kind of exposure do you have in oil? Ignorance isn't an excuse. It's your money after all, but you do have a responsibility. We at DiMeo Schneider have helped our clients kind of navigate this and understand and keep a prudent, balanced, diversified approach. Opportunities coming into this. So maybe you were too aggressive coming into the downturn. Your portfolio is probably down more than you would like it to be. And it's not easy to do in times like this, but there's things you can do to kind of right the course and maybe even come out better as a result. So thinking of cost savings approaches. So it's not comfortable, but can you cut some costs so you don't have to withdraw as much from your portfolio while it's down? Maybe on the other side, you can save a little bit extra and reinvest those to buy assets at lower prices. Another thought there is oftentimes investors contributing to the 401k will try and max it out for the duration of the year. Perhaps you can speed up some of those contributions so that you're able to buy more while the markets are low, and then front load that in the beginning of the year as opposed to evenly throughout the last of the year. So just a couple thoughts on maybe how you can take advantage of that. On the exact opposite side, maybe you were too conservative coming into this downturn. We had clients who have been sitting in cash since 2008 or the last few years waiting for the market to take a dive so they can put some money to work at cheaper prices. Times of panic are the time to do it. We're never able to pick a bottom. Dollar cost averaging is a strategy we employ oftentimes, where we let investors will pick one day at the beginning of each month and a certain dollar amount. And each month you put the money to work. And when the markets are higher, you're going to buy fewer shares. When the markets are lower, you're going to buy more shares. But over time, you get your cash and your dry powder back into the market and able to deploy and put to work. Again, it's important not to let the emotional pendulum of greed and fear swing too far in either direction. So whether you're too aggressive and now you're nervous that your portfolio has gone down, or you're too conservative and you're not sure what to do with your money and you want to be too conservative, just putting a plan in place and taking some sort of action. Once the money is put to work, we have a couple tactics we've worked with clients. So tax loss harvesting is often overlooked by clients with their taxable dollar. So not in your IRA, but think of your joint accounts or your individual registrations. It's for lack of a better term, it's making lemonade out of lemons. So when the markets go down, let's say you have a fund that you've lost $50,000 in, you can sell that fund and buy a very similar fund to keep that same market exposure, but you've effectively locked in that loss so you can carry forward that loss on your tax return going forward. So not an investment fund recommendation, but an example would be the Vanguard, maybe a Vanguard small cap fund. And so you would sell that, swap into a Russell 2000 index fund, you've kept your exact same exposure to the markets, but you've now added that asset to your balance sheet that can be carried forward for when the market does recover. You can then sell those assets and use those losses to offset the future gains. Let's see. Sorry, just lost my, there we go. All right, so what should you not do? The biggest thing, don't liquidate the portfolio in times of stress. So don't sell everything in the portfolio. Oftentimes the uncomfortable decision is going to be the right decision. Selling stocks when they're at all-time highs sometimes is difficult as well, because you get the feelings of euphoria, but in the good times are going to continue to roll. Similarly, markets making new lows, it may feel safe to go back to cash, but now is not the time to act irrationally in either direction. So we have a couple bullet points. What should you not be doing? Don't watch the news. Don't watch CNN. Don't watch the fast money folks. That's intended to be exactly what it is on TV, and that's entertainment. The purpose of the people they have on there is to get ratings, and so oftentimes it's not investment advice. The information is oftentimes sensationalized. And if you have an advisor, that's what you're paying them for. So call up your advisor, talk with them, review your plan, and kind of stick with that. Similarly, it's not the time to become a market expert. So in times of crisis, it's not a great analogy, but I'll use it anyway because I think it'll work with this group. Now is not the time to learn how to do surgery and perform it on yourself. You should continue to work with your professional and keep a level head. Just because an asset's cheap doesn't always mean that it's a good deal. So we use the example of oil, that there are many clients who wanted to get exposure to oil because it went down. But the problem is oil kept getting cheaper, it kept going down, it's since rebounded. But the point we make with that is that it's important to know what you own in your portfolio. So oftentimes investors got exposure to what's called USO, an ETF that's supposed to track oil. Because of the intricacies with that investment, though, it actually didn't track the oil market at all. And when we saw oil prices go negative, you're essentially left with this underperforming asset that both accelerated on the downside and then didn't participate in the oil bounce on the upside. So kind of tying 2 points together, know what you own, as well as don't speculate on particular asset classes and try and over or underweight the portfolio just because what seems cheap or what seems expensive. With that, I think we'll go to the next slide. Bill, do you have anything you want to add here?
No, next slide, please.
Oh, and the next slide is actually me anyway. Sorry. So on this page, we have a lot of numbers and a lot of colors. It's all important information, but I'll direct you to the right-hand side over here where we have all these colored numbers. And these are the daily moves in March that we saw. So what you're seeing is almost double-digit moves in subsequent periods. Again, to Bill's point, the big movements and the ups and downs are not indicative of a healthy market. So in March, we saw the average daily move was about plus or minus 5%. It was the most volatile month on history and the worst month for the S&P since October of 2008. So to the last point on the previous slide, it's okay not to take action. It's okay to ride out these waves. And if you did try and get cute and time the market, you can really get chopped up when you're trying to buy here and then sell here and then buy here. You can really deteriorate a lot of the return potential you have in the portfolio. So it's okay to just stick fast with the allocation that you've put into place. And we don't advocate clients to try and time the market.
Yeah, so along those lines of timing the market, we've had a lot of clients, and it's natural. It's a human reaction, right? You see things, Mike mentioned that you see things get cheaper. You saw things get real cheap here. Like I had said on that first slide, between February, March, certainly into April, cheaper than they've normally been. And everyone wants to think that they are a market timer, right? If I can get something that's 20% discounted, that's got to be a good buy. The reality is that human beings just in and of themselves, myself included, Mike included in this, make pretty bad investors, right? Because you start to have the elements of greed and fear take over when you're making behavioral decisions like that. So it's always, relying again on the advice of an advisor, of a professional, strategic rebalancing, sticking to your plan. These are the things that we're telling our clients at this point. Why? Because this slide comes up big time along those regards. And you'll see it in the bold across the top. Time in the market is more important than timing the market. It's very important when you're talking about a strategic allocation of an investment portfolio. What you see here is $1 compounded over a 70-year period. So this goes back 70 years. So granted, that's a very long-term time horizon, but it's going to draw out the point as to how important it is to stay invested and how detrimental it is to actually start becoming a market timer. So if just by dollar value, you invested $1 70 years ago, you'd have 100 compounded over that period of time. You'd have 192,000 and change if you had put it in and left it in the S&P 500. Now, if the S&P 500 had gone down and you said, this is one of those times I'm going to go to cash, had you excluded the top and missed one of the top trading days, you have a much different story. In this case, if you exclude the top 10 trading days, you can see that your dollar value compound return is less than half of what it would have been if you would have just stayed invested. You miss the top 20 days, and you're down in the $50,000 and $60,000 mark, way off of that high of 192,000. Top 30 days, top 40 days. So the reality is that by trying to time the market, as Mike said earlier, you're going to end up deteriorating your return, because the chance that you will pick and keep invested for the top days and make sure that you are in fact out for the bottom days, it's a fool's errand. And you see those same elements if you take a look simply one over to the right, just in terms of an annualized return. So you would have annualized over the last 70 years at just shy of 8%. And you can see how that deteriorates if you start timing the market, seeing if I can pick the top, pick the bottom. Listen, if you're out for 40 days over a 70-year period, that's not that hard to do. And you miss 40 of those top days, I mean, you're nearly half of where you would have been over that period of time. So again, we can't stress this enough. Part of a strategic allocation is staying invested for that entire period of time. And that is something that we are definitely telling and recommending to our clients. Next slide, Mike. So what does that mean for this? So we talked a little bit about, market performance. We made the mention that it's what you see there on that bar chart on the first page, going back a couple slides, is that it's indicative of an unhealthy market. Well, I suppose, no kidding, Bill. I mean, we can see that from returns. We can see that from our portfolio. But what makes this one different than others is the velocity at which it happened. And that's where this really took things by storm. And when we talk velocity, we're talking bear market. So what does bear market mean? Bear market means it's a peak to trough decline of 20% or more. So you've had, and you can see this on the left-hand side, you've had 13 bear markets since World War II. What does that mean? It means that they happen. I mean, this is part of the reset process of market cycles in the stock market cycle itself. Your average decline over 32%, peak to trough decline as of March 2020 is a minus 34. Number of days, trading days that it takes generally for this bear market to happen, if you look over those 13 occurrences, on average, it takes 116 days. When we talk velocity, this one, number of trading days, was 16. So that's lightning fast that we saw. And again, from the advent of this COVID-19 is where this is sourced from. So that's certainly something to keep in the back of your mind if you're going to go ahead on the slides prior to this and think that maybe you could pick the bottom, maybe you could pick the top. Mike mentioned the examples about oil. Those are very real examples. I mean, in March there was, which by the way was the most volatile month on record in the history of the S&P 500. You could literally give up had you tried to pick or day trade over a 2, 3, 4 day period. You could give up 1, 2, or 3 years worth of returns if you were on the wrong end of those trades. So something that we certainly were recommending our clients steer clear of until volatility settled down. And you've got some more statistics, and this will give you just an idea of how long we think, in order to come back, number of trading days from bear market start to exit. So generally speaking, it's 132. Velocity on this one was pretty fast. So we have a couple of question marks. As we go along in this, we will find out how long it takes to exit this bear market. But one thing that we do know, whether it's a bear market or whether it's a recession, and a recession is defined as 2 consecutive quarters of negative GDP. So we are in a prepackaged type of recession right now. We haven't quite hit it just yet, but we certainly see it coming down the pike, particularly with everything that's going on in the global economy. one thing to keep in the back of your head is, and we don't show it on this page, what do all of these recessions, what do all of these bear markets have in common? At some point, they do all end. And when they end, in every single case, we have hit new market highs coming out of that bear market, coming out of that recession. So that is certainly something that we are taking a look at. Remember, history provides guidance. It doesn't provide answers. And I think that's especially a point to make as we take a look at this page. Go up, Mike. And just to take that point out, one more step. This goes back, and so much has happened over the course of the last 3 or 4 months here. And then if you go back all the way back to March of 2009, so the last time we saw this type of an environment, and obviously a little bit different, but March of 2009, for those of you that remember, was really the bottom of the Great Recession. So as all those banks failed, and what you see here is a chart, a line graph demonstrating all of the things that have happened since March of 2009. And what you see is that there are up and down patterns. And I suppose if you expanded this out, you'd get a little bit more clarity in any given month, any given year time horizon. But the general theme here, to go off of what we had just mentioned, was, what do all bear markets have in common? They do all come to an end at some time, and they do all have new market highs. This graphic will show you that. March of 2009, and you can see as you move from left to right, all of the different things that have happened. S&P downgrading U.S. debt, the flash crash, the BP oil spill, government shutdown, Ebola, Charlottesville, emergency Fed interjection in the repo market. That was just a couple of months back. This, we affectionately call this your crisis du jour, right? There's always something that's going to be happening in the market, but fundamentally, what you see is growth happening to the tune of 495%. So if you try to time, you go to cash, like Mike said, as one of those don'ts, and you make those mistakes, this is what you end up missing out on. And this is exactly what the big don't. This is what you don't want to get scared away from, because this is how you grow a portfolio. You stick with the allocation, you stay invested, you rebalance back to your targets, all recommendations that we make to our clients at DiMeo. So with that, I will open it up. I think, Dr. Pollack, perhaps questions?
Thanks, Bill. That was fantastic. So as you know, the Fed and Jerome Powell has indicated that we should expect to see growth in GDP by the second half of this calendar year. And then he went on this past weekend to say that he expects the economy to be largely recovered relative to the current COVID challenge by the end of the next calendar year. Is this overly optimistic, and how much of that optimism is already priced into the portion of the recovery of the market that we've seen thus far? Or stated differently, does the market agree with it?
Yeah, it's a great question. And I believe what you're talking is, so as Powell was on it, I believe it was Face the Nation. And the follow-up to that comment, this next calendar year there was a piece there at the end of it, which was assuming no second wave. And so I think that's a big piece to the question that you ask. Is this priced in right now? I mean, the answer is yes, certainly to an extent. We're seeing a V-shaped recovery here in the U.S. I think as we start to say we're definitely going to be out of it, or we're going to see growth, it's great to see that type of optimism. Something that we have held at DiMeo since day one is the fact that this one's different. This bear market, this recession is different in that it will largely 100% be dependent on the confidence that we have a vaccine in place, that there are measures that can be taken to make this better for those who are sick, particularly the vaccine. So I think Chairman Powell's comments there, while optimistic, we'd love to see that. Without a doubt, it will come so long as there is a vaccine. It's not going to be the Federal Reserve. It's not going to be a portfolio manager. It's not going to be a bank CEO that says, yep, we're done. We can move on now. It will be decided by the medical community. It will be decided by doctors. It will be decided by the scientists. And when that comes around, that's the the catalysts we see happening in order for the turnaround to happen.
Thanks. So as we're well aware, this hit has occurred across the entire spectrum of markets, both international and domestic. Do you think the international markets are likely to recover at the same speed as the U.S. markets? So we see that U.S. equities have substantial opportunity in terms of their pre-COVID versus current valuations, but those opportunities are really less in magnitude than what we see in the international equity market, particularly in the emerging markets. Is it safe to say that Europe and the emerging markets are going to lag behind the U.S. measurably?
Yeah, I mean, again, this is one of those questions that's going to go back to some of the answers from some of the points that I had just made in the previous one. It's going to be about this vaccine, because while this is a global recovery that's happened, listen, I'll give you a couple of things to think about. Could the U.S. recover at a faster pace than international and emerging market countries? I'd say you can make the case that that's certainly a possibility. Why is that a possibility? Because we had lower unemployment going into this than the international and emerging market countries did. We have a more favorable tax structure, so we have lower taxes than places like developed and emerging market countries. That's certainly something that's a positive. The way that our entitlement programs, believe it or not, in many cases are less than the labor markets overseas. When you have those entitlement programs compounded by some unemployment that is higher generally than here in the U.S., historically speaking, those are things that would lead anyone to believe that the U.S. could be more resilient in terms of a recovery coming out of this pandemic. Now, what I will say is, going back to any of the previous slides about potentially cherry-picking countries, cherry-picking companies, trying to time markets in any grand fashion, this is a human pandemic. So you could also draw the case that while the U.S. may be positioned better from a financial standpoint, from just a country standpoint to recover out of this as a developed nation, the most developed nation, if that second wave, or God forbid a third wave comes and it hits the U.S. harder than it does international or emerging market countries, then pretty much all of the points that I had just made here are kind of off the table, because this ends up being another catalyst, another cause to the very downturn that we're seeing right now. So if European countries and emerging market countries and Japan and developed countries are able to handle this, contain it, manage it better than the U.S., you can make the case that it's anyone's guess as to who recovers faster. But again, it goes back to the confidence of the vaccine, the ability to eradicate this, from the face of the earth, to be able to actually recover.
Thinking about the recovery a little bit, the supply chain recovery is an area of concern for a lot of economists. There's a fear that as people get back to work, there'll be less stuff available for them to buy, less stuff available for them to use at work, potentially driving prices up. Should we be worried about inflation in our portfolios going forward? Is that a risk for the fixed income portions of our portfolios?
Mike? Yeah, inflation is an interesting topic because it's one of those things that's very difficult to predict. As you mentioned, globalization has really been thriving since the early 1990s. And so what that has meant for the U.S. is that we've gotten a concentration of both production and the capacity for things being produced is now in China. They benefited, as have we, with the specialization. But as we've seen, when it gets disrupted, it can be huge. It's a huge issue. And so we're likely to see companies redistributing supply chains. So to your point, that could cause higher prices, but a piece of inflation is going to be oil and commodities as well, which, as Bill pointed out in the first couple of slides, have really cratered this year. So we would argue that there's going to be probably pockets of inflation. It won't be massive pieces of inflation across the board, but things like medical expenses and healthcare, where are those going to go? You may see some government subsidies, which would be deflationary. Similarly, higher education. There's been a huge upward inflation on higher education for the last, call it 5-10 years. Is stay-at-home and e-learning going to be a new wave of that and drive some of those prices down? Do you want to spend $100,000 to go to grad school or $50,000 to go to undergrad school? to not sit in the classroom. And so it kind of remains to be seen, but we think that there's likely to be pockets of inflation. That said, equities actually tend to do really well in inflationary environments, which is why we want to have a balanced, diversified portfolio.
Great. Thank you, Mike. States and municipalities haven't yet really reconciled how they're going to manage the decrease in revenue from the tax base that they rely on. Is there a risk of substantial default in the municipal bond market? And how will this risk likely be priced in the coming weeks and months? Should we be concerned about that in rebalancing our portfolios? Or is this a sector we should avoid right now? Or is there value there that we might want to exploit?
Yeah, so within the muni market in general is just extremely fragmented. We would argue there's no need. We're keeping our clients invested in munis. We're not seeing a broad bankruptcy across the board where you're going to lose all your money being in muni bonds. We do still see them as a pretty safe asset class. That said, what we've done to kind of offset some of those risks is to employ active management. So we hire the managers who go in and they know every credit in the portfolio. They know what the underlyings, whether they're revenue bonds or general obligation bonds, where that money is coming from, who's at risk, and who's really not. And they're actually able to leverage their research and take advantage of some of the opportunities. A good example being a lot of folks, anytime you see a Chicago bond, want nothing to do with it. But if it's a Chicago Park District, well, they're still backed by the taxation of the city, and it's a relatively safe bond overall, even though it has the Chicago name attached to it. We've seen the Fed come out. They currently have a lending facility to buy muni debt. We think that they're probably going to backstop that. You've already seen some of these states like California, Illinois, and Connecticut are likely to follow suit, getting borrowed money from the Fed to make pension payments. So there's no guarantees that will ever actually have to be repaid. It's likely if we get to the dire straits that those are forgiven. So we do think that the Fed will backstop those. But there's certainly a risk, and we think that we can mitigate that by having active managers and really doing the due diligence and credit research on each of the securities you own in the portfolio.
That's a great answer. Thank you. Thank you. And then my last question. So the government has spent an unprecedented $3 trillion on stimulus to date. There's a second $3 trillion on the table right now, and that doesn't include anything that may come in the second half of the year. Now, while some of that will help stabilize the government entities that are addressed, that I asked about previously, there's risk in substantially devaluating the currency with this level of spending. How should we think about that in rebalancing our portfolios?
Yeah, Dr. Pollack, it's a great question. Yeah, we are spending. The U.S. is spending a lot. To put it into perspective. And this is also part of the answer. You put it into perspective, spending as a percentage of GDP, U.S. is 20% right now as a percentage of our GDP. You look at Japan, it's 100%. You look in Europe, you're at 50%. So relatively speaking, the spending, 20% is a very high number. Relatively speaking, we're doing it in a more controlled fashion, the U.S. is right now, than other countries. And that parlays into the second part of that question. How should we be thinking about that? Just what does that mean indicative for our portfolio? But remember, this isn't a pandemic that is only centered here in the U.S. This is happening in all of those other countries. So while we may be spending and we may be putting emergency measures in, the Federal Reserve is putting emergency measures in and doing these unprecedented programs like you saw during the Great Recession, other countries are doing the same thing. So you kind of get into a bit of who's wearing the cleanest dirty shirt, and that's something certainly to think about. This is happening all over the globe, so it becomes a relative measure instead of an absolute measure. And I think that's that's important when you're determining what that will mean in terms of anything longer term, devaluation of currency, anything like that in terms of the U.S.
So thank you, Bill and Mike. This was a really great presentation. And thanks, Andy. Your questions were spot on, and I think they reflect issues that many of us have been thinking about. So on behalf of the OREF, I hope you found the information provided to be interesting and useful. We hope to present webinars like this one on a regular basis. So until next time, be well, everyone, and thanks so much for joining us today.
Thank you very much, gentlemen. I'm Dave Gardy here for OREF TV after this first series of webinars entitled Do's and Don'ts in Volatile Markets. Thanks for joining us here on OREF TV.